We're having a tremendously strong day today. Dogecoin is up 5%. But let's put the jokes aside and analyze why there's such a bullish momentum today. The market is trying to extrapolate a few things that the Fed is saying and choosing to ignore the meat and potatoes. They're going right to the dessert. They're hearing 25 basis points dovish. They're hearing if inflation falls like a rock and continues to just decline in a straight shot, we might reevaluate our monetary policy. However, that accounts for maybe 5 to 10% of what the Fed is saying. The other 90 to 95% is what matters and is what their focus is and is what they're doing. And in my opinion, is more in line with the actual fundamentals, which were Goldilocks for inflation coming down. Let's not forget, we colloquially called it, and other people colloquially called it, the strategic midterm reserve. So let's break down a couple things here. The Fed is remaining hawkish. They delivered a nail in the coffin today, which the stock market seemed to ignore, but the bond market didn't really flinch. The stock market had a tremendous flinch today, tremendously powerful flinch. The bond market did not have the same kind of flinch. It really didn't move. Waller said a mild recession would be a good thing. The market is currently priced for rate cuts towards the end of the year, and quite a few of them. This is derived from the notion that we're going to experience a recession and that the Fed won't be able to tolerate a recession and they're going to have to cut rates. Well, they said today that a mild recession would be a good thing. Not if we get a recession, we'll reevaluate our monetary policy. They said a mild recession would be a good thing if it brings down inflation. And they're talking the way they're talking. They're having the projections they're having. The market is acting as if the Fed doesn't expect inflation to come down and therefore they have to fight them. The Fed is saying they expect inflation to come down to 2.5 to 3 by the end of the year. They're expecting inflation to come down. They want inflation to come down. They're doing what they're doing because they think it's going to come down. But they, as they've said, and as Waller said today multiple times, are going to err on the side of over-tightening. Why are they going to do that? Why are they going to deliver us all that pain? Because inflation is pain, particularly if you're at the lower end of the spectrum. And even with inflation at 2.5 to 3%, they're going to over-tighten, as they say, as a risk management proposition. They are guarding against the risk that inflation will come back. And we'll get into some factors that might make us believe, like the Fed believes, like they discussed in the last couple of days, that inflation actually might come back and might not be such a straight shot down. And we're looking at the data and we're seeing that in the data. So the Fed is not convinced like the market is that inflation is going to come down. Not a single Fed member is at 5% or below on the top terminal Fed funds rate. Do you know what the market is? Nobody on the Fed is at 5% or below. At least that I've heard in the past couple weeks that I can remember. There might be 2 out of like 17 or 19 on the S&P that are at 5%. Not one that I heard this week as we go into this blackout period at 5%. You know what the market is? 4.9% peak, and I believe 4.4 by the end of the year. Not one Fed member at or below 5 by the end of the year. So consider that another big unexpected rate hike for the markets and market pricing. But this is not the only aspect of delusional pricing that we're going to get into later in the video. So finally, the bond market, despite the stock market's move today, the bond market is not having it. And the bond market, I'm not saying they're smarter than the stock market, because they got the inflation transitory thing wrong too. But they weren't having Waller today. They weren't having Waller. Okay, not like the stock market was at least. Oil up 10% since the start of the year. Gas prices also up 10% since the start of the year. Lael Brainerd yesterday, who caused the market rally for a bit until the market came back when another Fed member spoke, said, and other Fed members have also said, that the reopening of China, an increase in commodity prices, etc., would not be good for inflation. You don't say. It would obviously not be good for inflation if commodity prices go up. Gas prices were a huge contributor to inflation on the way up. They were the biggest contributor to inflation on the way down, so far on the way down, and they're up 10% since the start of the month. That is a hefty margin, especially when we're just starting to turn the tide on all the downward forces, the SPR in China. Now we've got Russia possibly doing some cuts. I don't know, I'm not going to predict that, but it's something to think about and acknowledge as a risk in this inflation discussion. The Fed is discussing this. They're seeing it. We're seeing it in the data. You can go to Gas Buddy and you can check out the 1 month chart on Gas Buddy. You will see we were at the lows for the year, or the whole thing, and now we're curling back up. You can make the case that we're going to hit new lows, but guess what? The EIA and OPEC this week both increased their forecast for oil consumption. And while there has been some investment in production, it's a tight market. It was a tight market before. Consumption's supposed to go up to new records this year. They just revised those up, and production is not doing the same thing. Production isn't getting revised up like crazy. It's getting revised up over, longer periods of time. Companies deciding to invest big in investment, but then you have the governments saying, we want to phase it out. So why would you invest a lot? You'll invest a little bit, but it's not going to be enough to keep up with consumption. That's just not how capitalism works. You introduce external forces that are making things weird, and things are going to be weird. It's not going to be a perfect market. It's not going to find harmony. That's what we saw last year. We had to do artificial historical measures to bring it down, and we can't really do that anymore. They might try, but we'll see what happens. So, oil up. I don't expect inflation to have another tremendous decline again, if that's the case. If anything, I think it might reaccelerate. And the Fed wants 6 months of consecutive declining. Right now they have 3. If January is not a deceleration, if it reaccelerates, that breaks the trend. And the Fed continues to talk about that, but the market doesn't want to talk about that. They want to talk about, going all out, right? Going to new all-time highs. The Dow is pretty close to those, or at least was still pretty close. The labor market data remains tight. I don't know if anybody noticed this. Maybe they noticed it for a day and then completely forgot it and just focused on like 3 sentences the Fed said. But the labor market data, at least this week, coming in implying a hotter than expected labor market. I mean, this is tremendous data. Less than 200,000 jobless claims added. That is still, tremendously historical lows in terms of people getting laid off. So you see these headlines, you see these tech workers getting laid off. It's not really happening in the economy. It's just like one small speck of the whole picture. And particularly what the Fed is worried about are the lower income employees. And it's, you got to have this scale. Obviously, we want lower income people to have a comfortable life. But like the Fed is saying, they don't want to create it to be that wages are going up a lot and the productivity that those employees produce is not going up, because then you're going to get structural issues in the long run where they fire those employees and replace them with AI. Stuff like that. And it just screws everything up. They want balance in the force. They don't want craziness in the markets. They don't want craziness in the labor markets. They want to, as they said, return to the economy and the jobs market of 2018, 2019, and 2020. They're even fine with wage increases, but they need things to be balanced. Right now, they're very out of whack. Some things are super cool, some things are super hot. It's not, if you look at under the surface, it's like, oh, that's cool, but that's super hot. So they don't want that. It's obviously that will be the case to some extent in normal times. But right now, it's still a very unusual situation. So they're trying to get 2018, 2019, and 2020 back. We'll see what happens. So that's enough of the Fed. That's enough of inflation. That's only one part of the picture. We have a whole nother part of the picture that is relatively similar in importance. And some claim, like Mike Wilson at Morgan Stanley, who was the top-rated market analyst of last year, that the market is not accurately factoring in this portion. Mike Wilson claims, and I trust his judgment because he's a top-ranking official at a very large bank who communicates with very large clients who work in the corporate sector, and we are buying the cash flows of corporate earnings. He says he expects earnings to decline, and thus far we have seen some evidence of this. Despite the Netflix rally after hours yesterday and today, their earnings were not good. They were down. They were bad. Additionally, they cut future expected earnings. Okay, that's one piece of the pie. We have a big week next week. We have Microsoft, etc. What are the signs we're getting? What do we have to work with? With Microsoft, we have the CEO saying the next 2 years are going to be tough for tech. We have layoffs. We have layoffs at Google. We have, I believe, Sundar Pichai at one point. I saw an interview with him saying the future was uncertain, whatever. We have Tim Cook taking a 50-ish% pay cut. Pat Gelsinger, Intel, saying some stuff a while ago, last earnings. I think Texas Instruments just hired a new CEO. I mean, this is not all sunshines and rainbows here. I heard a good point yesterday that, maybe part of the reason the Netflix rally was occurring was because of the stock buyback. But why didn't they buy the stock when it was down 50% from where it is today? They just have cash and they're putting that to work. It's a stock market thing. I would not buy this company here at 30 times earnings. I just wouldn't. It's not for me. It's not for me. So you can make your own decision, but I think this is a multi-pronged situation, and I've explained that I think there is some issues with how the market is acting, and we'll see what happens. That's today's video, and until next time, peace out.